Hi everyone, this is Nancy. We're going to go over a few transactions in this video. Transaction E is saying that the company provided services on account. Whenever you see the word on account, you got to remember if it's a purchase on account, it means we haven't paid for it. Therefore, we have a liability, accounts payable. But when you see on account related to providing services, it means that we provided services, but the client didn't pay cash, and therefore we have a different asset called accounts receivable, which is a promise from the customer to pay us in the future. So in this transaction, accounts receivable, which is an asset, increases by $3,000, and on the right hand side of the equation, revenues, what type of revenue? Service revenue increases by $3,000. And remember that the five components of owner's equity is capital, 4 components, withdrawal, revenue, and expenses. Okay, then in the next transaction, we actually collect part of this $3,000 in cash from client. So we received $900 as partial payment for services performed on account in the last transaction, so cash increases, and now accounts receivable decreases, which means part of the promise has been paid off by the client. So our cash increase, accounts receivable, which is a different asset, decrease. So this transaction only affects the left side of the equation, but after checking our equation, our total assets equals the total liabilities and owner's equity components. The next transaction is paying expenses. What expense? Salary is expense. Whenever you see the word paid, it means cash decreased because we paid it with cash. So in this case, cash goes down by $700. Now, the other component of owner's equity, cash goes down by $700, and a component of owner's equity, which is an expense, also we have a $700. Now, we show it as a positive, but remember that the effect of expenses on owner's equity is negative. So a positive times negative shows you a negative number, and therefore cash goes down, and the effect on owner's equity also is a decrease. The next transaction is also payment of an expense. I'm not going to go over that, which is completely the same concept as the last transaction. Now, again, and this one is different. Transaction I, incurred advertising expense to be paid next month. So we have an expense, but we haven't paid for it. So the expense will be shown under the expense column under owner's equity, and since we owe money to the advertising agency, our accounts payable increases by $200. So $200 liability goes up, $200 owner's equity decreases. Both affect the right hand side of the equation, and therefore the equation stays in balance. In this transaction, transaction J, the owner, Jess, withdrew $100 for personal use. And remember, withdrawal is not an expense. It's a different owner's equity component. In this case, cash decreases by $100, and the withdrawal, the effect on owner's equity is a reduction. So reduction on the right-hand side of the equation, reduction on the left-hand side of the equation, this equation stays in balance. Now, after all equations are analyzed, you will see that we have a summary of all transactions and their effect on expanded accounting equation. And if you look at the assets, we have 3 different type of assets in this company, and we have to keep track of each asset in a separate column at the end of the month or all the transactions. The cash is $7,200. We have an accounts receivable, which is what the customer still owes us, $2,100, and total equipment of $1,000. If you add all these 3 items together, total assets are $10,300. Now on the other side, accounts payable, $500. Capital hasn't changed since the first day, still $6,200. We have a withdrawal of $100, revenue of $5,000, and total expenses of $1,300. Now it is time to prepare 3 financial statements. The first one is an income statement, which shows all the revenues and expenses and the difference between those two for the month or a quarter or a year for a certain period of time that has a beginning and end. So in this case, if you remember, our total revenue was $5,000 and our total expenses was $1,300. Since the revenue was only from one source, service revenue, we're going to only show the $5,000 in our income statement, but we need to show each expense separately by their name. So it's very important to remember the name of those expenses. If you remember, we had salaries expense and a few other expenses. Remember that withdrawal is not an expense. So again, income statement, you will start with the name of the company, the name of the report, and what period of time it covers. So starting with the revenues, always revenues first. In this case, our revenue is either service revenues or consulting fees, whichever you call it is correct for our company. And then we have our expenses, which is running the operation, so operating expenses, salaries expense, rent expense, advertising expense. We have to arrive at a total expenses. And we have 2 different columns. The column to the right shows the totals and subtotals. The column to the left shows the detail for that subtotal. And the difference between revenues and total expenses would be the net income if revenues are larger than expenses, and net loss if our total expenses are less than revenue. Now, the reason we prepare income statement first is that we need this bottom line net income, the $3,700, in preparation of the next financial statement, which is statement of owner's equity. Basically, it shows what happened to the owner's equity during that specific period of time. Did it go up? Did it go down? And what was the reason? We're going to start with the beginning owner's equity. So in our case, this company started on September 1st, and the owner contributed $6,200 to the business, and then it increased during the month. We had a net income of $3,700, which came from the income statement. That's why you have to prepare the income statement first, so we know what is the net income. You don't want to show all the revenue and expenses in this statement again. We just need the bottom line from income statement. We show the withdrawals for that month or the period of time, depending on when are you preparing this income statement. And withdrawals always decreases the owner's equity, and therefore the column to the left showing the effect of net income and withdrawals, and the subtotal, which would be an increase in capital in our case, is $3,600. Add the $3,600 to the beginning balance, and that would be the ending balance of our capital at the end of the month. So in this case, $9,800. The next, so far, if you look at the summary of all transaction, we are done with the owner's equity components. We prepared an income statement to show the effect of the revenue and expenses on the company. And then we also showed the beginning capital and plus net income minus withdrawals to arrive at the ending capital. Now it's time to prepare a financial statement that shows the assets, liabilities, and the total owner's equity. Basically, the basic accounting equation will show up in the balance sheet. So the balance sheet is our cash coming up from the summary, 7,200, accounts receivable 2,100, computer equipment 1,000, and so the total assets is 10,300. Then on the right hand side, like the equation that we have, we're going to show the liabilities and the ending owner's equity. So liabilities, we only had one, accounts payable. But if we had more than one liability, we're going to list them here and arrive at total liabilities. So the capital at the end of the month was 9,800. Where do we get that? It comes from the statement of owner's equity. Again, that's why we need to prepare a statement of owner's equity before balance sheet, so we have the ending balance of capital. And make sure that your total assets equals the sum of total liabilities at owner's equity. Otherwise, we didn't prepare this balance sheet correctly, and our basic accounting equation is out of balance.